Morning, market chameleons, and soon to appear Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Awesome. All right, let's go right to the disclaimer and get this show rolling.
Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's
Excellent.
The disclaimer.
Yep. What are you seeing this morning, buddy?
All right, let me share my screen. So take a look at what's going on in pre-market hours. Then we'll take a look at what's coming up in earnings in the next 2 weeks. Talk a little bit about that. Maybe take one or two stocks, analyze them a little bit more in depth. If you have any questions along the way, Will, let me know. I'll answer the questions. And if we have time, we'll look at some bullish, bearish ideas. So this is the pre-market report. We got the stocks trading in pre-market hours, got the most active, biggest percentage gainers, biggest percentage decliners. Let's first filter out the higher market cap stocks. So market cap 20 billion or higher. So you have here 29 on the percentage gainers list, 27 on the percentage decliners list. So pretty much even from that perspective, neutral at the open. This GME made the top of the list in this category. So that's up another 22.5%.
Yeah, that's what everyone's chit-chatting about.
GME? Yeah. So let's take a look here. Yeah, so you could see here, this was yesterday, 347, up 134%, up another 19% in the pre-market hours. 2.4 million shares trading hands in pre-market hours, and you see that it's a very small float. So it's already 10% of the float just trading in the pre-market hours, very active. I don't even know what to comment about this stock because this is something very unusual going on. You got to be careful here. Who knows what the real, where it's going to settle. But, this kind of volatility, it's not going to be sustainable forever.
Well, I'll tell you, I got an alert from one of my brokerage accounts that from that brokerage account, you're not even able to participate in AMC or GME.
So they're taking these stocks that a lot of retail folks are coming in and driving the prices a lot higher. You're saying that there are some brokers that are just saying you can't trade the stocks, like you can't buy it.
They had an alert at the top of the page, and they're like, listen, if you send an order in, it may, not be processed, basically.
Really? What if you need to sell it? What if you own it?
I stopped. It's a rabbit hole that I have tried to stay away from, because once you start reading, it's story after story after story. And Mike from Naples was mentioning something on the chat, and he had heard about a professional trader who bought the stock around 4 a year ago. Now he can't sell it because his company, is in bankruptcy, whatever. And so the stock's sitting there. So he's a billionaire on paper, but it has no access to liquidate it, is what he's.
Oh my
that's
God.
A story he read. But those are the type of things you kind of read out there, right? I mean, there's crazy stuff going on, and
look at I'm looking at pre-market 415. That's a new 52-week high, right? From yesterday's 380 was the high. There'll be a new 52-week high, and look at this range in the pre-market: $301, $513. This like craziness going on here.
Yep.
Here's its gap history, and you could, this is in the last 3 years, 12 largest gap moves. I don't even know. I mean, most of them are,
none of the data means anything at this point. This is all the volatility about the stock now, this moment in time. You have to,
it's pure. It's just,
I've looked at the options. Nothing jumps out at you. Unless you're electronically streaming as a professional and trading back and forth, it's It's a scary place to play. Recommend everyone stay away. But actually, Andy, who joins us every morning, Andy was saying that a lot of brokers won't allow you to buy these even now. And he says you can only sell, and that's obviously not a naked sale, right? You can sell probably to close.
Right, sell to close. Yeah, so there you have it. You know, they're trying to clamp down on these, but you just got a wave of buyers there. And where are they coming from? Like just social media sites?
Well, that's certainly how it's being portrayed. It's going to be looking in the rearview mirror, right, to see where it's coming from. But certainly these stocks are active on a lot of the Reddit message board, Discord groups. I mean, it's the power of social media.
Right. Well, here's the other. Is this one of them? KOSS up 480% yesterday, up 139% of pre-market. Like this one has a very low float, 1.8 million shares, already traded 1.6 million in pre-market. Look at this range: $53.38, $174 in pre-market. I mean, you know, this is here's the VWAP. Huh?
I feel like we're looking at cryptocurrencies
I think this is already more crazier than the cryptocurrency.
Yeah,
right?
No, it is. It is absolutely
this type of volatility.
It's a crazy time. I mean, it's even way different than, we lived through the internet bubble in the late 90s, early 2000s, and with that, those were actually products that IPO'd, had no earning, whatever, but these products we're looking at have existed for years. Like I'm looking at this KOS and this it's been around since 2011. It's like
right. It's not like this new technology that people haven't seen before and get really excited. This is more like,
this is people taking advantage of the market forces. I mean, they're heavy shorts probably in this one as well. I would assume a light float, and
there's a 10-year history of the stock.
Yeah.
So I don't know what's going on.
My only recommendation would be if management had the opportunity to sell, have a secondary offer and to raise capital, it would be a good time to do it.
Yeah, exactly. That's one thing that they can benefit, and probably
it may.
Itself will benefit in the long term if they could raise capital.
AMC had announced a secondary offering. That's the movie chain. That's another one that's been moving in this direction straight up. It's not even a hockey stick. It's a moonshot.
Yeah, I mean, I see today, but like just this huge spike to the upside. That's incredible to me. But for long, usually the skew. What's interesting is usually the skew is the other way, because you think it's the downside, right? When you're looking at options, it's always to the downside that these types of big events could happen. Now we're seeing them to the upside. It's like an upside crash, right? If you go and look at the skew throughout history and like the majority of stocks, you always see the skew that there's a potential crash to the downside, and the upside calls are usually muted, saying that the stocks will go up gradually and volatility will come in. Now it's like we're seeing it in reverse. I wonder if overall, if the skew is going to start to change, if we continue to see this, especially in the more liquid stocks, maybe now the skew will actually start adjusting. Well, that's what happened after the 1987 crash, right? We used to have like
Yeah, it's absolutely, it's interesting you say that. And you and I have, talked about previously, we may have mentioned it on shows, that there's no one prices a risk to the moon. And, if you have people are chasing assets, whether it's housing, crypto, and it seems like a lot of places where you can put your capital at the moment people are chasing. That skew could, flatten, who knows? It could invert. I mean, certainly in the commodities, it is always priced different than the stocks. The calls are priced, the skews run the other way, but it's
let me just take a look at the options chain, how it was yesterday. So, I mean, you could see like the volatilities are through the roof. It doesn't even matter. It's hitting the max implied vol. So you look, the bid for the nine strike is higher than the bid for the 8 strike. It's all over the place here. But yeah, it's interesting that if this continues, these are kind of just shocks when you have illiquidity, right? You don't have enough supply of stock and you get this rush of investors, they don't care. They want in. They're not like really looking at valuations. They just want the stock, no matter, price doesn't matter. You're going to get these big liquidity shocks. So
yeah, it's real interesting things going on right now. Actually, Goat, who just came on, mentioned he's got a mental list that he's put together of a couple. It's in the chat, but one he mentions, and we've talked about this with Chris Marcus before, is I guess the SLV. There's a heavy short in that, and Chris Marcus, who is a friend of the show and uses Market Chameleon. And another one he mentioned was I think that First Majestic, and that was also mentioned as a short squeeze.
What is the?
Well, one is SLV is obviously the silver, which is interesting because it's an ETF. You would think with the creation and redemption, maybe shares are easy. I would have thought, but I did notice from our threshold list, a lot of those on the threshold were ETFs.
The small. Let's just take a look at that threshold list one more time, and this is the threshold list where we talked about stocks that are failed to deliver that can, keep in mind, GME is still on that threshold list. It's still, on the threshold list. It's been on there 34 straight days, during the month, 100% a month. So whatever it is, there's still stock out there that is short and that needs to get, that if they don't find a locate, they're going to be forced to buy it in. And the way the way that works is that it doesn't matter if you have unlimited money and you could sustain losses on the way up. If you can't borrow the stock from somebody, you can't stay short. You have to buy that stock back in. And you see there's a small float, 27 million, and it's still on that list.
And since we're talking about this, it is interesting knowing market dynamics, right? If you're a hedge fund manager and have you seen what's happened and you play the short side, what are you doing right now?
Yeah.
Even if you don't have a position in AMC or GME, but you're short other stocks,
Yeah.
You're probably thinking about taking it off, right?
Well, yeah, because now you're seeing like who, how long, because if you're forced to buy it back, you can't even stay in for the long term.
Yeah, no, right? Well, that's always the risk, right? That's always been the risk. They've known that, but now it's like a supercharged risk. So really,
there's a couple of them that are, here's a couple in the last week. I'm just looking in the last week, some of them that are on this list, that are starting to pop. But I wouldn't play this game. I definitely wouldn't be buying stock in anticipation of a short squeeze, but maybe that is what's happening in this GME. So something unique, in this GME going on here. The volatility is incredible. And you just got this crowd of people willing to drive it up.
Yeah.
Let's take a look at the earnings.
Let's go to something we have an idea about. That's for sure.
Yeah. So we're taking a look at stocks that are expected to report earnings in the next 2 weeks. I'm going to use this filter that trade at least 5,000 option contracts or more on average per day. So take a look at the list. So we have over here a bunch of them today after the close. We got a couple tomorrow before the market opens. So let's take a look at a couple of them. WDC, that's expected to report today after the market close. As of yesterday's close, we're not open yet. As of yesterday's close, the straddle is implying a move of 8.8% in either direction, up or down. That compares to a 4-quarter average move historically of 8.1% and a 12-quarter historical average move of 8.1%. So a little bit above that, kind of in line with those historical average. The high move on WDC in the last 12 quarters, 18.2%. MDLZ, that's expected to report today after the market close. The straddle's implied move of 3.7% in either direction. That compares to a 4-quarter average move of 2.5% and a 12-quarter average move of 3%. High move on that in the last 12 quarters, 7.8%. I'm going to start just skipping down. There was a bunch of them to like ones with higher volumes in the options. So Visa here, that's today after market close, expecting the straddle's implied move of 3.8%. That compares to a 4-quarter average historical move of 2.3% and 12-quarter average move of 2.3%. High move on Visa, 4.8% in the last 12 quarters. X, that's, I believe, U.S. Steel. Let me just open this up to get the informational. So yeah, United States Steel over here. That's expecting, as of yesterday's close, the implied straddle is expecting to move 10.3% compared to historical 4-quarter average move of 4.2% and a 12-quarter average move 6.1%. High move on that 17.3% in the last 12 quarters. Did you say something, Will?
Oh, it's just really they're expecting a bigger move than typical.
Yeah. So we'll take a look at this one. Then I'm going to come back to it. Maybe we'll take a look at U.S. Steel. I can take a look at Visa. Here's Caterpillar. That's tomorrow before the market opens. The straddle, as of yesterday's close, is implied to move of 5%. That compares to 4-quarter average move 2.3%, historical 12-quarter average move 3.6%. High move on that 9.1%. Eli Lilly. Tomorrow before the market opens, we got CVX, HON. Tomorrow before the market opens, that one is expecting to move 3.7% in HON compared to a 4-quarter average move of 2.3%, 12-quarter average move 2.3%, a high move on that 3.8% in the last 12 quarters. So let's take a look at U.S. Steel, maybe Visa if we have time. Caterpillar, some of these with more volume. So
now just refresh us. Why is it maybe more interesting or more important to look at ones with more volume?
Well, you certainly don't have to, do it this way, but we're just going to take a look at the ones with more volume.
Well, for me, chances are with more volume, there'll be tighter markets. So I would think
just in general,
easier to get in and out of. Yeah,
exactly. And you don't have to, just depends how exactly, but easier just to get. The assumption is that the markets are more liquid, easier to get in and out of. But you could do the analysis any way you want, trade any way you want. I mean, people trade GME, right? And you saw that's
not very liquid.
Tolerance, huh?
Not very liquid GME.
Right. So I'm going to take a look at U.S. Steel here. And from a historical perspective, let's first take a look at its historical moves versus what the straddle implied prior to the move. So we see here these bars here up and down. That was the straddle implying the move in either direction. So I'll show you here. I'm going to hover over it. October 29th, after the market closed, U.S. Steel reported earnings. They're down 1.7%. The straddle was implying a move of 7.3% in either direction. So that move was more muted than the implied. Here, this green bar is telling us that the stock was up after the market closed. after U.S. Steel reported earnings. So you see October 31st after market close, stock reported earnings. Stock was up 14.8%. The straddle was implied a move of 7.2% in either direction. So there, if you sold the straddle, you would have to buy back higher, and you would have lost money on the sell side. On the buy side, you would have made money on that straddle. And we see here the statistics here. Half the time, the straddle overestimated the move. Half the time, it underestimated the move. So it's like 50-50 here. On average, the straddle implied a move of 8.1% in either direction prior to earnings. The average of the historical realized moves was 7.4%. So you got about 0.7% differential between implied and realized historically. I'm going to take a look here at U.S. Steel really quickly. And let's just, because I'm going to start looking at more at fundamentals, but let's just take a look last time what it did. So these are what the actual reported earnings versus the estimated earnings by analysts. So we could see here that, and I just kind of want to point these things out, because the more I point it out, like, I think people understand it, that the stock does not necessarily, and this just happened to pop up, and I'm noticing, but the stock does not necessarily have to go up if they beat earnings. It's really what's behind the number. So we see here, October 29th, the company beat analyst estimates by 24 cents. They beat the revenue by $120 million, but the stock was down 1.7% after reporting those numbers. So I'm hovering over there, negative 1.7%. You can see the stock day before closed at $9.83. The next day after reporting earnings, it was $9.66. Okay, so that's because whatever they said, it's what's behind the numbers, what the management is saying about their future outlook. You know, how did they even get to this number? There's lots of stuff going on, and if you're just looking at, beat, or you're right, like, you would not be happy if this is the number you looked at and right away bought the stock, because by the end of the day, it was down. Now take a look at this. It closed at $9.66. Right now we're at $18.66. Okay. This is what that analysts are anticipating this time around, that they're going to lose 68 cents and their revenue is going to be 2.6 billion. Right. So if we compare that to the fourth quarter of prior year, so last time, fourth quarter, year ago, they lost $1.11 per share. Analysts are expecting them to lose 68 cents. So to do better, still to run at a loss. As far as the revenue goes, last year, 2.8 billion in the fourth quarter, versus now they're anticipating 2.6 billion. So in revenue, they're expecting them to do worse than last year, but earnings per share, even though they're expecting a loss, but not as big a loss as last year. So those are just what the analysts are putting into their, on average, putting into their models or publishing those estimates. But I'm going to take a look at this post-earnings drift here. And the idea behind here is, here we go. So this is what happened last time. Prior to earnings, you could see October 29th, the stock was up 47%. And maybe they did beat earnings, right? We did see they beat earnings, but the stock was down 1.7%. And that drift, right, was already pricing in a lot of good news, right? So it's not like the stock was just sitting there between, the prior earnings. It wasn't sitting at the same price. It drifted higher, and it was up 47.8%. So what we got here is, this is one thing. This is prior earnings, up 47.8%, right? It went, you could see here, from second quarter after they reported earnings. It was down 9.5%. Then in between, right, you have 3 months to go in between, drifted up 47.8%. So even though we got this beat, there's also a lot priced in, right? Because we see that drift. A lot of it was priced in and it was muted. I mean, it was down 1.7%, wasn't down a lot, but it didn't, it was hard for it to get pushed up even higher. So what happened since this one, 1.7%? So now here's this green, this is where we are now, up 90.5%. All right, so we're up 90.5%. That's equivalent to 6.3 standard deviation move. You know, these are the moves between earnings. So the green guys are the up moves, the red guys are the down moves between earnings, and this blue guy over here, that's the earnings effect. So we could see here that a lot of times those drifts were lower. So you could see here, the one I'm hovering over, it drifted lower 36%. After reporting earnings, though, it was up 17.3%. So keep that in mind. Not only the B, you know, what they report, they could report good news, bad news, or they could report really good news. But what about going into the earnings? Is the stock pricing in a very good earnings effect, a muted one, or bad one? And here you see that 90% move. It's already anticipating something good coming from the company. So something good coming from the company, that upside potentially could still get muted. If it's bad, you know, watch out, right? Because we got all this priced in there. Again, this is current drift, 90%. On average, it drifted lower 3.8% in the last 12 quarters. And a standard deviation, one standard deviation move up or down, 14.3%. All right, is there any questions there? We just pushed out this graph. Usually you didn't have the graph. If you want to take a look, last 24 quarters. So this is in the last 24 quarters. So we had this one big move up 179%. And you see the earnings effect was only 0.2%.
Just so everyone knows, Dima did say this is a brand new feature. So be sure you check it out, and any feedback with new releases is super helpful.
Yeah, and again, you know, that this graph is the new feature, and as you know, and I'm still working on more insights on this, but yes, this here, at least visually, you could kind of get a sense of how much since last earnings, how much did we move, and relative to historical moves, the magnitude of the move. Hopefully that makes sense. Let me take a look at really quick. The other thing that we did add is when you're on here, you know, here are the historical dates that they've released earnings. If they have guidance or earnings, we put a press release to it. So this way, you know, you could kind of go take a look like, oh, they guided in between. What did they guide? So here, you know, they provide guidance. EBT is expected to be approximately $55 million. They expect the fourth quarter loss on the diluted base, 85 cents. So they did provide guidance in December in between earnings. So now you kind of have this benchmark, you know, are they going to beat their own guidance, right? So here you kind of can go here, and we should start extracting that information. We'll see if our vendors can do that for us, but and also you could kind of go back to the last quarter, go to the press release, see if they issued any guidance within their last quarter. Okay, so this is just a quick link to go there and find out what's going on with the company, what they're saying, where the concentration of their revenues coming from, and kind of start your analysis from there. We're up 9:30, Will.
Yeah, just a quick, when is that fundamentals tab coming out? Robert Black is asking.
So this fundamentals tab, I'm still working on it. There's actually more to it than you're seeing here, but this fundamental stuff, I think in February, we're going to start rolling it out. And this is basically here. We see United States Steel. We're going to give it like a fair value or implied value based on historical multiples. So if it reverts back to its historical multiples, we see here, you know, its average PE ratio in the last 3 years, its average price to sales in the last 3 years, and then relative to the SPY, we've seen about $15 is the on average. So we're a little bit above that, but you know, that's not too far away either.
Awesome job bringing us chameleons all these features, Dima. Awesome job. Listen, quickly, one of the chameleons, Go Roper, mentioned Biden outlawed private prisons yesterday. So we may want to take a look at the REITs tomorrow, just real quickly. Remind me, or I'll remind you.
Yeah, so we'll take a look at those, see how they're reacting.
Yep. All right. Thanks, D.
All right. Thanks, everyone. Have a safe day. Stay safe. Have a great trading day. Hope to see you guys tomorrow.